In the last 3.5 months, that's from early May to late August, U.S. 10-year Treasury yields rallied from 3.35% to a high on August 21st of 4.35%. Now, the rally's explanation was simple. The narrative back in May was that a recession was imminent and that the Fed would have to pivot to neutral or easy in the near term. That's changed to the higher for longer soft landing narrative that exists today. Of course, that narrative is linked tightly to the notion that inflation continues to fall while, at the same time, growth holds on. So it's probably not coincidental at all that 10-year Treasury yields have traded in a tight range over the last week between 4.22% to 4.3%, as it's the week before Wednesday's extremely important release of August CPI. The expectations here for the number are for an uptick in year-over-year CPI to 3.6% from 3.2%. But much more importantly, a drop in core CPI to 4.3% is predicted from a last read of 4.7% year over year. Now, if the number surprises to the upside, it could fuel a belief that the Fed may need to become more aggressive in raising short-end rates. Now, interestingly, long-end rates may interpret it in one of two ways. First, most likely is that the market will think that higher for longer trade is intact, and that will be supportive of 10-year yields. However, there is a contrary school of thought that many think that a more aggressive Fed in the near term means a more aggressive pivot in the medium or long term, forcing longer-term rates lower. Second, the latter could fuel a notion that the relative safety of 10-year Treasury yields at 4.3% could attract waves of money that may be scared of risk assets if inflation is in fact reemerging. Now, if a trader believes that yields could fall from here, they could express that by selling the September micro 10-year Treasury yield futures contract at 4.28 and targeting a move back to the psychological level of 4.00. A stop for this trade could be placed above at 4.42. Now, this trade could make $280 if the target is reached and risks $140 if you're stopped out of your level. Now, if a trader believes that yields could rise from here, they could express that by buying the September micro 10-year Treasury yield futures contract at 4.28 and target a move up to 4.75. A stop for this trade could be placed below at 3.90. Now, this trade could make $470 if the target is reached and risks $380 if you're stopped out of your level.